Okay, hello everyone, and welcome to this episode of 4 Quarters and a 10K. I'm your host, Jess Abraham. Now, as you know, I'm just an amateur investor, like many of you listening to this. Been doing this for about 10 years now, learning new things every single day. Today, we're going to do a really deep dive into Netflix's first quarter results for 2025. I've got the shareholder letter here, earnings, call transcript, all the good stuff. My goal, as always, is to cut through the noise. We want to pull out the key insights on Netflix's performance, understand their strategy, and figure out what it all means for them. And the wider streaming industry in general. We'll focus particularly on some of the big shifts they seem to be making and what those changes really signal. All right, let's dive right in then. The financials for Q1 2025. What's the top line? Revenue came in at $10.54 billion. That's up 13% compared to the same quarter last year. That's solid. How did that stack up against what analysts were expecting? Well, it actually edged past expectations. Not a huge beat, but positive nonetheless. Okay, I heard the real story might be a bit further down in the income statement. And that's where it gets interesting. Operating income. Operating income is the profit that a business makes from their core business. It hit $3.3 billion. That's a big jump, 27% year over year. And that pushed their operating margin, which basically tells us how much profit they make for every dollar of revenue, up to 31.7%. 31.7%. This number was 28.1% in Q1 last year. And analysts were actually expecting something more, a lot less this quarter. So while the revenue beat was slight, this outperformance in the margin was pretty substantial. This suggests they're getting more efficient, basically turning those revenue dollars into actual profit more effectively. And that improvement also flows down to the net income. Net income is the actual bottom line profit after everything. Net income for Netflix in Q1 2025 reached $2.89 billion, which is basically a 25% year-over-year increase. This translated into a diluted EPS, or earnings per share, of $6.61. I remember seeing the consensus estimate somewhere, and it was a lot less. I think it was $5.61, or maybe it was $5.67 to $5.69 range. But basically, the bottom line is they had a big beat on the earnings per share. Free cash flow is basically the cash left over after they pay for operating expense and capital expenditure. This is a very important metric. And the free cash flow also came in strong at $2.66 billion. That's another 25% increase year over year. So yeah, financially, Q1 looks pretty good, at least on the surface. Is there a catch to this? Well, it's not really a catch per se, but there is an important context that has to be mentioned. Management pointed out in their call that the high operating margin in Q1 benefited from the timing of some expenses, specifically content and marketing spending. They expect that spending to ramp up in the second half of the year. So the point they're trying to make is this 31.7% margin isn't necessarily the new norm quarter to quarter. It does align with their full year guidance, which still remains at 29%. So Q1 was strong, definitely, but we should expect some moderation in that margin as the year goes on. Does that make sense? Now let's talk about something that feels like, a major strategic shift. It's the way they report the subscriber numbers. They've announced they will stop reporting quarterly paid memberships and ARM. ARM stands for Average Revenue Per Member. Starting from Q1 2026, they will not report those two metrics. That's kind of a big news if you think about it. It's a fundamental change in how they communicate their progress, and frankly, how they want investors and analysts like us to evaluate them. So, what's the reasoning behind ditching these metrics we've relied on for so long? Their argument is basically that the business has evolved. They've got strong profits now, good free cash flow, and increasingly important revenue streams like advertising and the extra member features. So just focusing on raw subscriber count alone, they argue, gives an incomplete, maybe even a misleading picture. Because, think about it, a subscriber on the lower priced ad tier is different financially than one on the premium tier, or someone paying for an extra member slot. The pure number doesn't capture those value nuances. Hope that makes sense. So if subscriber numbers in ARM are out of quarterly reporting, what are the key metrics now? What should we amateur investors be tracking? They're pointing us towards three main things: overall revenue growth, operating margin expansion, and free cash flow generation. So top line growth, profitability, and cash. Makes sense from a purely financial perspective. They did say they'll still announce major subscriber milestones, like when they hit the next big round number, 350 million or whatever, but not the quarter by quarter net additions. It forces a rethink of the growth story of Netflix. It's less about sheer volume and more about value extraction and profitability. Interesting. It actually requires an adjustment on how we analyze them as a company. Okay, let's quickly look at how things played out regionally in quarter one of 2025. How did the different parts of the world perform? So UCAN, that stands for US and Canada, brought in $4.62 billion. That's a 9% year over year growth. Still growing, but maybe not as fast as it once was. It was actually slightly below estimates and definitely a slowdown, a deceleration compared to the previous periods. This suggests, maturity in the market. What about internationally? EMEA, which stands for Europe, Middle East, and Africa. They performed slightly better, it looks like. $3.41 billion in revenue, which was up 15% year over year. And it also beat expectations. Okay, strong showing there. What about Latin America? They came in pretty much in line with the estimates. $1.26 billion, which is up 8% year over year. Asia Pacific is often seen as a key growth area, and it absolutely smashed in Q1. Revenue there jumped 23% year over year to $1.26 billion, significantly beating estimates. 23%. That really highlights the contrast, doesn't it? You see the difference between the more saturated markets like North America and these high growth regions like APAC, Asia Pacific, where their investments seem to be paying off quite well. That international expansion strategy seems critical, no doubt about it. Now, how does Q1 compare to the quarter just before, Q4 of 2024? I remember Q4 had a huge subscriber growth. It was massive. They added something like 19 million net subscribers in Q4 of 2024, crossing the 300 million total member mark. That was just exceptional. So coming off that high, how did Q1 look sequentially? Let's look at the revenue first. Revenue growth from Q4 to Q1 was more modest, up around 2.8 to 3%. Not a huge leap quarter to quarter. What about profitability? Now that's where the numbers get dramatic again. Compared to Q4, Q1's operating income surged by nearly 48%. 48% quarter over quarter. Net income was up about 55%. EPS was also up around 55%. And the free cash flow basically doubled. It went up nearly 93% from Q4 2024. Let me repeat that again. It went up 93% from Q4 of 2024. That's amazing. So the revenue basically ticks up slightly, but the profits, they just explode. What drove this massive jump from Q4 to Q1 when it comes to profitability? There's no straight answer for that. It's basically a combination of factors. We talked about the expense timing, basically lower content and market spend, probably hitting Q1 compared to Q4. We talked about the seasonality, but the scale of the jump here suggests more than those basic factors. There's operating leverage. That's the idea that as revenue grows, even modestly, costs don't grow as fast. So a bigger chunk falls to the bottom line, especially in a subscription model. Then you have the price increases they implemented that's starting to kick in really hard, probably even hitting their full stride. This makes each subscriber more profitable on an average. And critically, the growing contribution from the advertising business. Yes, that's the key. Ads inherently carry higher margins. So as that scales, it really boosts overall profitability. So that jump in operating margin from 22.2% in Q4 up to 31.7% in Q1, it's a mix of cost timing, leverage, pricing, and ads. That seems to be the most logical explanation. Yeah, a confluence of positive factors hitting profitability hard in Q1. Okay, let's unpack those drivers a bit more. How much impact is pricing factors having? They're definitely a significant driver. The increases they push through in the US, Canada, UK, Argentina, France, management said they're performing as expected, meaning people are generally accepting them. It's boosting that ARM figure, average revenue per member, that we talked about. Even though this ARM figure is not something that they're going to report every quarter, it definitely happens. It definitely has an impact in the background. Interestingly, they made a specific note about the UK. They noted the UK only got a partial benefit in Q1, so there's more to come from there. They expect the full quarterly benefit to hit the UK starting in Q2, which they think will re-accelerate revenue growth in that specific region. This shows their pricing power. Pretty good. And the ad revenue sounds like it's taking off too. They're sticking to their forecast of roughly doubling ad revenue in 2025, building on strong growth last year. Doubling it this year? That's ambitious. But the momentum seems to be there. Remember the Q4 data point? Over 55% of new signups in the market with the ad tier chose the ad plan? That's a huge share. And this shows that demand for lower price point. If you think about it, it's a high margin revenue. It disproportionately benefits operating income as it grows. Kind of makes sense to me. What about the content slate? Q4 had some big guns, like Squid Game's return and various live events. How did Q1's lineup compare? I mean, Q1 had things like the series Adolescence, films like Back in Action, Counterattack, etc. But it wasn't as great compared to the stuff that we had in Q4. Q4 had NFL games, the Jake Paul fight, Squid Game's return, etc. So maybe Q1's lineup was not in the same vein. But Netflix management consistently argues their strength lies in the breadth and the variety of the slate, not just one or two massive hits. Catering to diverse tastes, they also reported that the engagement and retention remained healthy in Q1. So the strategy seems to be working, keeping people subscribed even without these Q4 level tentpoles. And we should circle back to that cost management expense timing that we talked about earlier. Crucial context for the Q1 margin. Lower spend in Q1 is expected to increase in the second half, especially in Q4 with big shows returning and heavier film slate, plus more marketing. And the paid sharing impact, basically cracking down on password sharing, is that still a factor? Well, it's likely providing some ongoing baseline benefit to revenue, yeah. The initial surge from that is over, but it's still contributing. But the extra member feature specifically isn't a huge needle mover. They haven't highlighted it as a major driver at all. Seems like the main benefit came from converting sharers into their own accounts or getting them into an existing one under the new rules. Okay, let's shift gears slightly and look a little deeper into the big strategic initiatives. Advertising seems to be front and center. It's clearly becoming a core pillar, not just an add-on. The big news is rolling out their own ad tech, the Netflix Ad Suite, kicked off in the US and Canada with 10 more markets planned. Why is having their own tech or ad tech so important? The answer is two words: control and capability. Basically, it gives advertisers more flexibility, better targeting options, and better measurement. And this ultimately should allow Netflix to capture more ad revenue. They reported good initial feedback. How are they selling these ads? It's a mix. Doing upfront deals, big commitments made in advance, and also expanding programmatic options. Programmatic options means automated buying and playing in the regular scatter market, which is buying closer to their air date. So, content investment is still a huge part of the budget, billions globally. They highlighted big commitments in Mexico, like $1 billion over a period of time, and $2.5 billion in South Korea. What's the strategy behind these global spend? It's about making content that hits locally first, developing local talent, but using their platform to export those stories globally. Find the next Squid Game, essentially. And live programming? They dabbled in live programming in Q4, but they've been selective, calling it big breakthrough events, things that generate buzz and make economic sense, rather than, say, bidding billions for a major sports league right now. What about animation? That's definitely a focus area. They want to build long-lasting animated franchises. Mention hits like Leo's, CB's Pinocchio. They seem to think that there's an opportunity here. They're also exploring newer formats and techs. Things like video podcasts are being explored. And in the world of AI, they mentioned starting a film using AI for de-aging, which apparently is much cheaper than traditional methods. They're looking for efficiencies all over the business. They also talked a little bit about their gaming initiatives. It is framed as a long-term play for engagement and member value, not an immediate revenue source. Steady progress is the message when it comes to gaming. What kinds of games are they focusing on? There's a few types, really. Games linked to their own IP, like Squid Games, mainstream licensed titles like Grand Theft Auto, kids games, like they just announced a new Peppa Pig game. It comes to having breadth and width again. All kinds of games. Pricing and paid sharing. How's that evolving? Pricing, they insist, is tied to value added, not a diskette schedule. Ad plan gives them flexibility. Post-password crackdown, the focus seems to be on stable acquisition and retention. Let's turn to the earnings call itself. What was the vibe from the manager? I'm not going to go over all the questions. I'm just going to try and condense all the questions and answers in the earnings call here. The management seemed confident. I would say resilient. They really hammered home the strong Q1 results, credited pricing, ads, and that expense timing we discussed earlier. They emphasized the ability to perform well even if the economy gets choppy. And they also talked about the Wall Street Journal piece suggesting they aim to double revenue by 2030. They did address it. They were careful though to frame it as internal long-term aspirations, not official guidelines or forecasts. They're trying to manage expectations basically, signaling ambition but keeping the official targets grounded. It's really smart if you ask me. What were some of the hot topics in the Q&A? Well, there were a few topics that came up. Economic sensitivity was definitely one of them. Management said they haven't seen major negative impacts so far, and the ad plan helps buffer things. They reiterated pricing is linked to value delivery. No hints of imminent widespread hikes, but the option is always there, they mentioned. They explained the expected margin moderation in the second half of the year. Again, we touched on this earlier. Higher content cost, especially in Q4 with the big returning shows and films, plus more marketing spent. Ads, content, gaming were all brought up too. There was a lot of discussion about ads, a lot of positive feedback. The upfront and programmatic plans, the benefits of their own ad tech for flexibility and measurement, etc. They talked about their content strategy a little bit too. They reaffirmed the focus on breakthrough live events, animation goals, exploring creator content. They mentioned things like Miss Rachel, Kill Tony, Sidemen as examples of performing well. They're really leaning into that creator space. They also talked a little bit about capital allocation. How are they spending their cash? Consistent policy. Reinvest in growth first. Keep enough cash in hand and return excess cash via share buybacks, assuming no big M&A, which basically stands for mergers and acquisition. It's their standard playbook. So overall, a good Q&A session. So let's wrap the numbers section with the actual forward-looking guidance. What are they projecting for Q2 and the full year? For Q2 2025, their guidance actually came in ahead of consensus estimates, pretty much across the board. And by that I mean both profit and revenue. Revenue, operating income, operating margin, EPS forecast for Q2, or all of them for Q2 were higher than what the analysts were expecting. What does this signal? It signals continued momentum from Q1. They expect the full impact of price hikes, especially in UCAN, US and Canada, and the ongoing ad growth to keep things humming along nicely in the near term. They even expect the revenue in US and Canada to re-accelerate. Okay, so Q2 outlooks look strong. What about the full year 2025? They maintained their prior full year guidance, revenue range of $43.5 to $44.5 billion, operating margin target of 29%, and free cash flow around $8 billion. So the full year picture hasn't changed despite the strong Q1 and Q2 outlook. The math still works out. The strong first half of the year, profitability, that 31.7% in Q1 and the guided 33.3% for Q2 is expected to come down in the second half of the year and hit an average of 29%. This reduction to 29% is mainly because of the higher content and marketing expenses that they expect later on in the year. The full year revenue assumes ongoing member growth and pricing impact, and that doubling of ad revenue we discussed earlier. So, pulling all of this together, and after digging through everything, what are the big strategic takeaways from Netflix's Q1 2025? I think the clearest takeaway is that this strategic pivot towards profitability and diversified revenue streams is real. Q1 shows that they're executing on this idea successfully, and stopping the subscriber reporting really underlines that focus in their shift. It forces everyone, us included, to look at the financial metrics: revenue, margin, free cash flow. Strategically, they all seem pretty solid right now. What are the main challenge that Netflix faces? To be honest with you, balancing these long-term investments with near-term margin and cash flow expectations. That is a balancing act. But the management seems confident in their resilience. They have reasons for being so confident. They say pricing power, the ad tier offering a buffer, the fact that home entertainment holds or tends to hold up relatively well in tougher economic times historically, all this gives them confidence. The focus now is just sustaining the momentum, proving this diversified strategy works long term. Okay, so for you, the listener, wrapping it up, Netflix is clearly prioritizing profit and finding new ways to make money from each user. Forget just counting subscribers every quarter. That's the old playbook. Think advertising growth, think pricing power. Those are the engines now. Content is still king, obviously, but Gaming, live events are strategic side bets for the future, aiming to increase engagement and value. And maybe a final thought to chew on. If a subscriber count isn't the main yardstick anymore, how do we really measure Netflix's success and influence in this crazy, crowded entertainment landscape going forward? What other metrics truly capture their position and growth potential? It definitely forces us to look at those streaming giants through a different lens now. It really does. A shift worth watching. Well, thanks for tuning in today. And if you liked it, please consider liking and subscribing my channel. I'm new to YouTube and I'm learning every single day and trying to improve the quality of both the content and delivery. So if you have any suggestions, please leave them in the comment section. I'll be very happy to read them and potentially implement them. Thank you again for your time, and until next time, adios. Bye.